at least 25% of all mineral lease rentals, royalties, proceeds will be placed in a permanent fund, the principal of which will only be used for income producing investments. And all income from the permanent fund shall then be deposited in the general fund unless otherwise provided by law. So this is very clear. It's very straightforward. And you'll notice that there is no mention of what the money should be spent on once it leaves the permanent fund and is deposited into the general fund. This is a renewable resource that I think we are seeing, especially in the last 3 years, how important this has become to the state of Alaska to have taken something that's non-renewable, like the development of our natural resources, and turn them into something that all generations of Alaskans can truly benefit from. So this graphic is designed to try and help explain to some degree how the money flows through the fund. So you'll see that we get contributions from royalties. We also get contributions from special appropriations, inflation proofing. All of that money is then deposited into the principal. The principal is constitutionally protected. It's invested in those income producing investments. And the income is then deposited into the earnings reserve account. So the earnings reserve account gets its money from the stock dividends or bond interest payments or real estate rentals, any of that cash flow. If we sell an investment and realize a gain, that gain also gets deposited into the earnings reserve account. That money is then available for appropriation. It is used to fund APFC operations. It is used to pay investment fees. And now it's used for inflation proofing and the percent of market value, which I'll go into more detail further into the presentation. The permanent fund really is set up as a 2-account structure. So as I said, you have the principal, which is constitutionally established as the permanent part of the fund. And it does grow through those royalty contributions, special appropriations, and inflation proofing. And then this earnings reserve account was statutorily established to hold the net income of the fund's investment portfolio. It grows through the recognition of statutory net income. Statutory net income is really that cash inflow that you think about. It's not an accounting, it's different than accounting net income. It does not recognize the change in market value, but only the actual cash you receive from your investments. And it's important to note that that earnings reserve account is available for appropriation in its entirety. So when we look here at the principal, you'll see that as of August 31st, which is our most recent month-end numbers, September came to a close yesterday. We won't have September balances for another couple of weeks as we go through and reconcile all the accounts. But as of August 31st, there was $46.7 billion in contributions to the principal, and it had associated unrealized gains of $8.5 billion. With the earnings reserve account, we had $6 billion of realized earnings, and along with $1.6 billion. And I'm not sure if you can see this because I have a feeling you're also seeing the pictures in the Zoom call, and I can't pull the screen forward in front of that. But what you're not seeing is $3.1 billion in the earnings reserve account set aside for the FY22 POMV amount. So really what is truly unencumbered for future legislatures to appropriate from is the $6 billion as of August 31st. When we go to the contributions to principal, I think one of the things that is really important to recognize is that out of that $46 billion, $17.6 billion is royalties. $18 billion comes from the allocation, the appropriation of inflation proofing all these years. And you can see the legislature started appropriating inflation proofing in 1983. If you think back to that time period, it was a time when inflation was especially high. And there was a recognition that if the principal wasn't going to be able to keep any of its gain from it making the investments, that from a cost basis, in order to create some sort of equality among all generations of Alaskans, we were going to need to inflation proof in order to protect the purchasing power of those royalty deposits. As a result, inflation proofing has become a huge source of growth for the principal of the fund. And then even more extraordinary, I think, is the $11 billion in special appropriations. These have occurred in various time periods, most recently in FY20, which we just closed out June 30th, where the legislature set aside and the governor approved, setting aside $4 billion into the principal. So taking some of that gain that had built up in the earnings reserve account and really recognizing the need to share it among future generations of Alaskans and build up that core principal amount to the $46 billion. So $11 billion has been saved through the years through these special appropriations. So the permanent fund really has become a very, if we didn't think it was special before, we should really think of it as special now, because all of these actions taken through the years have really contributed to both the size and the ability of the fund to meet its demands that in a time like we're in right now, where we really need the fund to help with all of the things the state is facing. In 2018, the legislature approved the POMV, or percent of market value. And this is a value based on a prudent draw mechanism. And the idea was, not only do we have a prudent investment directive within the statutes to the Permanent Fund Corporation, but to really work on having a prudent spend mechanism in order to maximize the value of the fund and recognize the needs the state had for the fund. Effective July 1st, 2018, the draw was 5.25%. It's calculated on the first 5 of the preceding 6 fiscal years. So there is a smoothing effect based on whether or not the fund grows or the fund happens to shrink, to sort of not create the volatility and big impact that you traditionally saw from the movement, for example, of oil price shocks that could really create havoc with revenues to the state under the reliance of oil. So it was 5.25% for the first 3 years. And the idea is that this would help provide a glide path into a long-term use of the fund, which becomes effective July 1, 2021. So we are currently in fiscal year 21, the last year of that 5.25% draw. And now we will be moving for FY22 to the 5%. And we are forecasting that POMV for 23 and 24 will be roughly the same $3 billion amount that it has been now for the last couple of years. In 1980, Governor Hammond signed into law the creation of the Alaska Permanent Fund Corporation. So we are celebrating in 2020 our 40 years of service to the state of Alaska. And the idea was that there would be an independent entity that would manage the investment of the fund and to remove it out of the Department of Revenue and have it be a dedicated team that would be responsible for this particular fund. We have one mission here at the corporation, and that is to manage and invest the permanent fund and any other funds designated by law. And our vision is to deliver outstanding returns, which will benefit all current and future generations of Alaskans. When we look at the asset allocation that we have set, you're going to see how over time, over the 40 years of the corporation's management, it has really evolved. And this is really due to both a recognition of risk, return, and confidence in the funds, in the corporation's ability to and the trustees' ability to manage this money. So in 1980, we had a very simple allocation. We bought bonds, and that is all that we invested in. To give you a sense, many of you, I am sure, know exactly where interest rates are today. If we were invested solely in bonds, we would be looking at sub 5% returns easily in the current environment. We've also been able to diversify the risk for $65 billion by putting it into different types of assets, whether they be in hedge funds, in private credit, or private equity, and in real estate around the world. Looking forward, though, I think this is probably the question that I get asked, is really trying to figure out, are we going to be able to continue given the volatility in the market? With COVID, March was a wicked month. We saw a terrible drop, very fast drop in the market. And since then, there's been a recovery to that. We ended the fiscal year in positive territory, which was very much a relief. You'll see we ended 2020 at 2.01% for the return, which was a great place to end, because I think in March at one point we would have been down easily in the 20 plus category. And as we look forward, though, there is concern about a recession, about not just a US recession, but a global recession. The interesting thing about the pandemic, among a number of things that the pandemic is doing, is that this is not a US centric event. This is an event that is affecting the global economy as well. And so as we look forward for the next 10 years, where do we think markets will go? Will we be able to achieve the returns we expect? I think you're going to see these returns from Callan. They've already indicated that they expect these return numbers to come down some when they release revised capital markets forecast in January. And that would be consistent with where we're seeing markets headed. We're in a period of very low interest rates, and public equities continue to perform, but it's not clear to anyone whether or not that is something that can be maintained over a 10-year period. As a reminder, we were in prior to COVID hitting in February, we were in the 12th year of a very long bull market run, and there was an expectation that markets would have to retract in some way anyways. And so we continue to expect that. We are forecasting a 2021 total return over 10 years of about 6.48%. So what's really important to note in that is a 10-year forecast, not a one-year forecast. And so the one-year numbers could look very, very different, but over the 10-year time period, we expect the fund to return about 6.48%. If inflation returns to normalized levels, we would expect inflation to be around 2.25%, which means we would have a real return of approximately 4.2%, which is below the 5% real return target that the trustees have set for us. So we've got some work to do, but we recognize that we also can't take unchecked risk with the portfolio. And so part of this will be really looking at for opportunistic periods where we can maybe take advantage and generate those returns that Alaskans are relying on. When you look historically at the fund value and the returns, you will see that the total return is this blue line, and it primarily falls in these two bands, which are between 0 and 15%. So rarely have we seen the fund fall into negative territory. The big time periods were with the tech bubble in 2000, and then with the great financial crisis that came in 2007 to 2009. In 2005, the legislature passed significant legislation affecting the Permanent Fund Corporation and the fund itself. And that's when they removed the allowed list of investments from state law and actually put in place the prudent investor rule that the trustees follow to this day. That's also when you'll see the spike in valuations, because we were able to then deploy capital into a variety of markets, not just the US market, but into the global economy. We could also get into different sectors, and we could get into different asset classes such as private equity. And that has really benefited the fund in the last 15 years since that prudent investor rule was put in place. So when we look at actual performance, I talked about this a little bit earlier, but you'll see that the total fund performance for FY20 was 2.01%. I'm pleased to say that this did allow us to beat our passive index benchmark. As a reminder, the passive benchmark is if we did not actively manage our investments, but rather we just had the fund invested 60% in passive stock indexes like the S&P 500. We had 20% in passive bond index funds, and we had 10% in REITs and 10% in TIPS. TIPS are Treasury inflation-proofed securities to create that hedge. That is an investable index, which is really important because it allows you to create an alternative to what you're actually doing that you could invest in that has the same risk profile as what you're trying to do with your active management. And you'll see that we beat that benchmark by about 71 basis points, 73 basis points. That 73 basis points equates to 476 million. So what that tells us is that through our active management, we were able to generate an additional 476 million. When we compare our active management to the performance benchmark, which is also an active management creation by the board to really evaluate how effective our active management strategies or tactics are, you'll see we came up short for the fiscal year. We did not beat our benchmark. We came awfully close, 4 basis points, but we did not beat the benchmark. You'll see, though, over 3 years, we have significantly beat the benchmark on a performance basis, and we have as well on the 5-year time horizon. So some of the strategies we have taken are longer in nature and don't reveal themselves to be as prudent or as effective in 1 year. But over time, they have proved to be very effective by beating that benchmark. And then the total fund return objective of CPI plus 5%, we have generated since inception. We have beat this benchmark by almost 100 basis points. So 8.6% is our total fund return since inception, and the total fund return objective of CPI plus 5, which is a very long-term objective, was 7.59%. To give you a sense of what the corporation has done in terms of contributing to this effect, the return Alaskans have on APFC as an investment versus the fund as an investment. So if we were a private business, how would you evaluate whether or not we were making money or not making money, and that there was a good return by appropriating money to have APFC run this versus having some other entity manage the fund? You'll see that we generated $1.8 billion in accounting net income. On a statutory basis, we had just over $3 billion in statutory net income. If you think about this in trading days, so these are days the market is open and available to make investment decisions. In FY20, there were 253 trading days. That means we were generating $7.1 million per trading day in accounting net income and $12.3 million per day in statutory net income. Compared that to our expenditures for FY20, which came in at $120.4 million. So we've been able to really cover the cost of APFC by managing and building this internal management capability. I think that the piece that people are really, that we need to talk about is just how important the permanent fund has become to the unrestricted general fund revenue. So when we look at this chart, you'll see that starting in 2015, petroleum revenue and non-petroleum revenue, and you'll see that big white area to the left. This is not a spike in revenue or a spike in spending, but that was the gap that was being filled in the past by other reserves that the state had, for example, the Constitutional Budget Reserve. So there were other sources that the state was tapping in order to fund the level of government that Alaskans were asking of its government. Since 2018, when the POMV took effect, you can see that we became very quickly a big portion, or the fund became a big portion of supplying needed revenue. So in FY20, unrestricted general fund for FY20 was $4.6 billion. The POMV was $2.9 billion, that covered 64%. From a total revenue standpoint for the state of $11.4 billion, so this includes all the revenue the state is giving, for example, from the federal government and among other sources that are restricted, the POMV supplied 26% of that revenue. For FY21, it's even greater. So 73% of all unrestricted general fund revenue is going to be supplied by the investment earnings of the permanent fund. And so when you think about the effect of this here in Juneau, all the things that the community here relies on for unrestricted general fund spending, whether it's education spending, it's other types of public safety contributions, things like that. It's really meaningful what we are able to generate in terms of investment returns for the state of Alaska. This includes the dividend. It's important to note the dividend is calculated and is spent now out of the unrestricted general fund bucket. So when you see the 73% for FY21, just know that the dividend payment is included in that 4.2, is included coming out of that unrestricted general fund revenue number. Okay. Somehow I seem to have lost. Oh, I have not lost anything, just so you know. I think our next slide, the next slide that's blank, actually had a link to our website, which is apfc.org. There's a tremendous amount of information that you can find on our website. We just posted our annual report, which I think everyone will find of great interest. There's a lot of really good information in the annual report. It's one of my favorite publications every year. I'm kind of a nerd that way. We've also started posting educational videos. The first one is definitely up there. You should be seeing the second one come on in the next week, I think. And these are videos that we're creating. They're short. They're about a little over a minute long. And they're really designed to help educate Alaskans about how the fund works and the things that we are doing. You can also find a lot of fun news, the trustee papers. In December of 2019, the trustees released trustee paper number 9. This is a fantastic resource for lessons learned, both positive and negative, about what can happen with sovereign wealth funds when their missions are diverted or they're given multiple competing types of missions. I think one of the biggest issues we are going to have here at APFC looking forward to the upcoming session is trying to distinguish between what we are doing long-term and creating intergenerational equity and what is possible to do in the short term, and not confusing our mission in conflating the short term with the long term, because if we lose sight of our long term investing, we will quickly deplete the fund for a number of reasons. We will deplete it both through imprudent spending out of the fund, but also it will affect our ability to invest long term if too much of it is getting used too quickly. We will not be able to make commitments to long-term investments like real estate and private equity, which are so instrumental in contributing to the overall fund and our ability to deliver on the POMV. So with that, I'm happy to open it up, Charlie, for any questions the group may have. I don't know if there are any questions. And I will stop sharing well, I'm not going to stop sharing my screen because I may need to go back to some of the graphs for a moment. So we'll see.
Okay, so now that I've managed to figure out how to take my mute off and get my video going again, there is one question. Looks like maybe another one's populating now. So the first question is, the Permanent Fund Corporation, now just located in Juneau, will soon be opening an office in Anchorage. What and how many positions will be working there?
So I want to be really clear. The board is considering, but no decision has been made about opening an Anchorage office. There was thought that an Anchorage office may help with recruiting and primarily recruiting talent to the corporation. I think what we've learned with COVID, so on March 24th, we all went home and hunkered down like everyone. And we have been so rewarded by how well we've been able to keep fixed income trading. So if you think about in all the investment activity, but I think where it really got highlighted was in the fixed income group. This is a group that manages 20% of the portfolio. They trade daily from right here in Juneau. And the question was, can we do this from home? And surprisingly enough, because of the investments that have been made into our technology, into our systems, and the investment into the middle office, we were able to do that. And we continue to be able to do that. So for those of you who may be wondering, we are not back in the office full force, full time. It is voluntary. And a lot of that has to do with trying to juggle all the things we have to juggle with childcare, elder care, just all the challenges that have come with COVID and trying to manage through some of these things. And so that ability to work remotely has really highlighted that what we need for recruitment is maybe not necessarily a physical space, but more thinking about how we do our work, not where we do our work.
Great, thank you. So the next question is that some have proposed drawing multiple billions from the earnings reserve account for a variety of uses, including PFDs, deposits to the unfunded pension liability, and etc. How would this impact the finances of the state and the corporation's ability to generate maximum returns?
Yeah, no, that's a really good question because, and it's a challenging one for me to answer because there are such needs in the state. And so you have these sort of competing spaces. But if you say you took that earnings reserve account and you drew it down to zero this year, and you allocated it out to all the various things you mentioned, whether it's paying for the cost, funding up some of the retirement liability, it is used to pay dividends, it's used, and it's used for all the other things that the legislature and Alaskans may want. What's going to happen is it's going to accelerate the need for fiscal reform in the state, in that you're going to see our ability to earn if you're relying on us to come up with $3 billion a year over the next 3 years, but that's being calculated assuming that we have this 6 billion in the earnings reserve account invested in earning that money. If that money is gone and we now have a $60 billion fund rather than a $65 billion fund, what's going to happen is you're not going to be able to generate that $3 billion for FY23 and FY24. And so while you may have taken care of some really important short-term needs, you've done it at the cost of those future years. And it can be really hard thinking long-term. It is probably the hardest thing we ask our elected officials to do, is to think beyond an election cycle, or to think beyond this year's budget, because there's no reward for that. There's no, yes, I'll be sure to vote for you because you're going to take care of my kids. It's, what have you done for me this year? And so that tension is really challenging. But if we don't recognize just how important it is to stay disciplined, we will have these problems for years to come.
All right, thank you. So how will competitive salaries in the investment world affect your ability to hire investment staff? Got a crystal ball?
Yeah. We are seeing, we're seeing the effect already. We're seeing public funds in the lower 48 that want to build up their teams. They recognize that if they build up the team internally and pay competitive salaries, they can significantly reduce their fees to outside managers. Just to give you an example of how much value there is to an internal team, if you take fixed income, we have one individual in fixed income whose part of his responsibilities are to manage cash. We have $2 billion in cash that is invested overnight, or it might be invested out 30 days, depending on what the cash needs are. But it's a really short time horizon. You can invest cash overnight and on these short times with, for example, our custodial bank, Bank of New York, Mellon, would be more than happy to do that. They charge what would be considered peanuts, maybe 1 basis point. Well, 1 basis point on $2 billion is $2 million. If I do the math right, or maybe, no, it's $200,000. Sorry. I always do this wrong, but it's $200,000. And that is more than what we are paying this individual to do that. So there is real savings in a really small way to having that done here in Juneau. If I lose that individual because someone in Illinois is willing to pay that, or Wisconsin is willing to pay that individual more money, how have we benefited from that? So I think we need to just remember that the competitive salaries, this isn't about paying what Carlyle or KKR are going to pay their private equity people. This is really about, how does it make sense for a public fund to continue to pay, recognizing also that we no longer have a defined benefit program here and haven't had one for 15 years. So the golden handcuffs we once had are no more and haven't been for a while, but are still in place in these other places. So we just have to recognize just how challenging Alaska is going to have it, not only recruiting for the permanent fund, but recruiting for state talent in general.
All right, thank you. Can you talk about the secondary private managers? How many and how much money do they make?
I'm not sure who is being referred to in secondary managers. So, we have a number of managers, and you can find most of them listed on our website. We get an appropriation of about $125 million to $135 million a year to pay as an appropriation to pay management fees that are outside of any performance fees. So these primarily go to public equity managers that might be managing specific strategies for us. We have about it's either 28 or 30 public equity managers alone, but each asset allocation has a stable of managers that they can go to if they need to. And I should also mention that we also post every quarter on our website our total fee picture. So you'll see our investment management fees for each asset for each allocation, how much has been paid directly from the investment before receiving returns to us, how much is being paid from the appropriation we get, and then also, and that's management fee without regard to performance. And then to the extent we may have a profit sharing arrangement, where if they hit certain hurdles, they get a share of the profit and we get a share of the profit, you'll see how much of that they've been paid under those arrangements as well. All of that's on our website.
Great, thank you. So there has been a perennial discussion on investing portions of the permanent fund portfolio into Alaska projects. Can you provide some color on the status of the past and current initiatives to do this and where this discussion is headed?
Sure. So the trustees, I want to say 3 years ago in 2017, adopted a motion to put $200 million into an Alaska Invest. It's important to note that our statutes, our responsibilities pertaining to in-state investing are found in 3713-120C for anyone who wants to go and look at the statute reference. But it specifies that if an Alaskan investment has a similar risk and return comparable to what we would see outside of Alaska, we're to choose the Alaska investment. Over time, it's been very difficult to meet these hurdles for a variety of reasons. Part of it is the scale of the investing that we're required to do versus what's available in Alaska. And secondly, is also that risk return profile it's been hard to measure. So the $200 million program was designed to help see what actually is out there. $100 million was allocated to McKinley Capital for private equity initiatives, and $100 million was allocated to Barings for sort of private credit infrastructure initiatives. We have deployed $5 million so far under that program. And those returns, you'll see them under private equity and special opportunities as the in-state program. And it's important to note that when you invest in private equity or private credit, there is what is called a J-curve effect. So you will see negative returns for some time as you're paying management fees before you start receiving returns on these investments. So we're in that period right now where we're paying fees. So it generates a negative return because more is going out in those fee payments than is coming in. I know that both firms feel like they have a really good pipeline of potential investments. COVID has hindered it to some degree because they have not been able to get out into the field and do due diligence in the same way that they would be able to if we were in a normal environment where you can go out and actually see the company, meet with the executive teams of those companies and things like that. But I'm happy that there's a good pipeline, and hopefully we'll see more of that come in.
Great. So it looks like we have one more question, and this question is, what are the management fees associated with the fund being actively managed? Is there an analysis of the difference if it had been passively managed?
No, I don't think we break out that way. And to be clear, passive management does have fees associated with it. So we look where we measure the success is not on the nominal dollar being paid, but on the net effect to the fund. So that's why it's so important to continue to look at the returns via that benchmark. Because while I can't tell you how much our fees are compared to what the fees might have been for that benchmark, the fact that it outweighed that benchmark by over 450 million, I think is what's really important, is that that active management is generating over and above any fees we would have paid on past, any fee differential that would have occurred as a result.
Okay, great. Well, thank you, Angela, for joining us today and answering our questions, giving us a great presentation on the PFD and corporation, and appreciate your taking the time. So it's my job now to congratulate our new board of directors, which are Connie Hulbert, Scott Bergman, and Ray Thibodeau. I want to also welcome to the board of the Juneau Chamber of Commerce. So I'd like to remind our audience that nominations are open for just one more week. The deadline to submit nominations for Citizen of the Year and Lifetime Achievement Awards is October 8th. Please visit the Juneau Chamber website and you can download a form there and submit who you think should be the Citizen of the Year and receive a Lifetime Achievement Award for 2020. So Maggie, did you have something? I noticed you unmuted. Okay. I want to thank everybody for joining us today. Please join us again next week. Melanie Shivens will be giving a presentation on Southeast by the Numbers. Everyone have a great day. Be safe. Please remember to wear your masks. We are adjourned.
Thank you, Angela.
Thank you.